We have rallied in large part, not only because of NVIDIA and concentration risk, for sure, but also because the market is pricing in reaccelerating growth and or Fed rate cuts, which seems counterintuitive. But regardless, where are we now with big picture? You talked through the Fed rate cuts, dialing it back a little bit, expecting that in the SEP, the SEP, et cetera, et cetera. Where are we at with economic growth? Big picture. Plateaued or rolling over? Again, there's a mix. I know you talked about that at the very beginning.
This short clip is presented by EDGE. EDGE is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about EDGE, visit www.laductrading.com/edge.
Yeah, look, I think we have this guy, folks have named it like a K-shaped economy where wealthy and homeowners who have locked in low rate mortgages and who can still borrow money and who can earn 5% interest on their T-bills or their money market funds are doing, and have jobs that are making 4 or 5% more a year have strong asset portfolios are doing great. I think that part of the economy is doing well. And that's why you're seeing services inflation very elevated and housing inflation remaining strong. And then you have the bottom half of the K. The other half is those who don't own homes, those who have low discretionary income, those who have no assets, who are paying more for everything and who are working 2 jobs and who are having trouble paying credit card bills and who are having trouble paying auto bills and can't really thrive in a stagflationary economy where rates are at 5% to the government and 20% on credit cards. So I think that's the economy we have. What I think we have as we push through every day that goes by, I think we're getting closer. And I think we've actually probably hit this tipping point where the long and variable impacts of monetary policy are biting an increasing segment of the economy, and it's offsetting now the positive impacts that we've seen from higher rates paid out by the government. So before we really weren't seeing the impact. We were seeing the benefits from higher rates, which is kind of counterintuitive, but really because people with low rate mortgages or companies with low cost borrowings were able to kind of earn that interest rate spread that had offset the higher rates. I think now, as we're 2.25 years into higher rates, and we've been at 5% or more higher for a year, it's biting more. So I think the data has topped. I think the economic momentum has topped, and so the economy is slowing, but I don't think it's slow. We're moving in a slowing growth momentum economy, but the longer we stay up at these elevated rates of interest, the worse the landing will be. And the reason we have to stay up here for longer is because inflation is not being solved. And the reason inflation is not being solved is because the Fed doesn't look at financial conditions. And so they're allowing asset prices to remain incredibly robust. They're keeping liquidity too ample. And so it's just, we're not getting any alleviation on the overall pricing front.
They said historically they said they would cut if they see a weakening in the labor market. We don't have that. Obviously, tomorrow is not going to be enough to move any decision for June. But also, we don't have wage growth deceleration. It's actually up 4%. So It is beating inflation on the aggregate. So we do have wage inflation.
And if productivity is 0, which is what we've had for the last 2 quarters, then it's not, 4% wages are not conducive to bringing inflation back down to 2%.
So they're really in kind of a sweet spot. If you, for an election year, they are kind of threading that needle.
I think the Fed should do nothing. I think they shouldn't cut rates. I think they probably shouldn't raise rates. They should do nothing and say nothing, and give the economy time to slow down gradually, bring inflation down. The problem is they have this bias towards cutting. And that bias towards cutting is keeping financial conditions incredibly loose. They're as loose today as they were at the beginning of the tightening cycle across a variety of metrics. Yes, overall, certain parts of financial conditions are higher, but you have to look at the entirety of financial conditions, and there's various indicators. The Chicago Fed has 105 indicators in its toolbox, in its metric of financial conditions. And Fed has one that looks at 7 indicators, and Goldman has one that looks at 12 indicators, and Bloomberg has one that looks at 50, whatever. And so we don't know exactly, but even the Chicago Fed one, which is the broadest one, which looks at 105 different indicators of financial tightness or looseness, is today looser than it was in March of 2022. So for the Fed to say monetary policy is restrictive enough to bring inflation back down to 2% is wrong. I mean, they're gaslighting, or they're lying, because I don't think they're naive. So I think they know that. But until they deliver, or until they introduce this idea that they really are going to be higher for longer, and they're not going to cut at the first whiff of growth slowdown, and they're going to stay out here for the rest of 2024 and into 2025 if necessary, the market's just kind of calling BS on that, which is why gold keeps rallying and stocks keep rallying and Bitcoin keeps rallying. It's the same thing we've been talking about for months.
We have
the market will continue to go up until the point where the Fed is uncomfortable with kind of forward inflation expectations reaccelerating again. And we've bounced around, and I've tried to be negative on small caps because I think they're and they've underperformed. They've certainly underperformed NASDAQ. They're underperforming gold. They're underperforming Bitcoin. But because they're not getting the earnings momentum and the benefit of interest rate policy like the cash rich big cap tech guys are. But look, every time liquidity stays ample and NVIDIA goes up 5%, it kind of drives everything up. It reduces vol and lifts all boats. So IWMs or whatever, flattish or uppish, a scratch from when I started really doing it. Certainly it's underperformed. Certainly it's not been as fun as I would have been better just to be long NASDAQ in that environment. But gold has done great. Gold's done great and Bitcoin's done great. So it's helped.
But at the same time, most of NASDAQ has very, very select AI tech leaders that are, if you were to remove them,
the breadth is deteriorating in a big way. This is not a uniform, broad-based S&P and NASDAQ at all-time highs. This is a market that's being led by fewer and fewer names that are into basically effectively one theme, AI and the build out of AI, which is a great theme, and it's going to be here for a long time. But everything else seems to be falling away. Really have other areas of leadership. Consumer discretionaries been rolling over. Healthcare's been okay, but materials and energy have they've done okay, but they're not keeping pace in this most recent last 2 to 3 week move. It seems like the market is getting very narrow on AI. I don't know. Something doesn't feel right to me. So I have this like pang in my stomach about when I see things like Mexico, which is a very consensus trade, really start to unwind on a political outcome that was very expected. It's like a frying pan was reached. Like people didn't realize that this woman who's an AMLO disciple was going to follow through, was going to win and follow through and then deliver on status through. And it's like, this was fairly obvious. This was a pretty obvious thing, but because of the carry trades that are so ingrained, it literally is taking. It's still not even. We're still not even through the first inning of the reversal here. And today Mexico had another 2.5% move in the end because there was actually some talk about them doing these reforms in September, like they said they were going to do. And so it's like the market is like getting hit over the frying pan, and they finally react. And then you had a similar thing in India, where that was actually a little bit more of an unexpected political outcome, where Modi didn't get as much of the support as folks were thinking. That's been a consensus long, and that got hit. And so there's some weird. Oil obviously really has broken down. Again, there's some things going on cross asset wise which are concerning, which I don't think necessarily would support the stocks at the all-time highs. And then to your point from earlier, it is interesting that in this bond move, bond volatility has actually been rising.
Yes, this is the one thing I didn't expect.
and I think that's
it's like what
it was. The move index was flat. It was a little bit down today, but it's been up since that. And we talked about this last week when we were on. We saw the move is breaking down, and again,
I still expect it is just biding its time because I'm still seeing move lower into the summer, but it is very, very interesting how it is moving higher as yields fall. That's not
It's
normal.
not typically how it works.
Yeah, exactly. So we
so-
definitely have a dollar weakness that is contributing to this market ramp. And I see this as weakening further. At some point, it's going to become a headwind that both dollar and yields are falling. Maybe the market wakes up and says, hey, maybe we don't have the economic growth, or maybe something's wrong. But right now, they haven't really kind of reached that level. I think they will. The market participants, whatever, 4.2%. If we actually break that.
The long end is the long end.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.